Good morning, dear students. Welcome to the home mentoring session of accountancy. Myself, C.S.K. Khanna from the SD Vidya School, Ambala Kent. Dear student, today we will start part B of your accountancy syllabus. Part A we had covered, and in the part A we had completed two important segments. First was relating to partnership account, and second was relating to company accounts. In the part B, we have to understand very important areas relating to the analysis of financial statements. It is also known as the financial statement analysis. Dear students, this important part comprise basically 5 important lessons, and out of those 5 important lessons, 4 lessons are basically practical lessons and they are very easy. From this part, you have also to prepare your CBSE final project. So we are going to study this part very comfortably, very easily, and understand in our true spirit. Now, in this part, today I am going to start with a very important lesson that is called accounting ratios. Now, before we start any topic, we must understand what the basic meaning or what the basic definition of the concept which we are going to start. So relating to the accounting ratios, first of all, we must understand that what the financial statement is and how they are to be analyzed. Basically, financial statements include all the statements, all the notes, all the schedules, which helps us to understand the financial position of an organization. For example, very simple, from trading profit loss account, from balance sheet, from capital accounts, we can understand some basic information relating to the organization. The other part is financial statement analysis or analysis of financial statements. Analysis of financial statements here means that we have to analyze the financial statements. In the class 11, we had learned how to prepare them. We had learned how we prepare the cash book. We had learned how the bank reconciliation statement is prepared. We had learned how the assets account are prepared. We had learned how the financial statement like trading profit loss account is prepared, how the balance sheet is prepared. In this part, in class 12, we will learn how those financial statements to be analyzed. Analysis means that when we have to make financial planning, it is important that we review them. We must understand the information, and on the basis of that analysis, we could draft our future or projected plans or the important projects to be undertaken. So, in order to analyze the financial statements, we had certain tools. Tools means those instruments with the help of which the financial statements to be analyzed. Now, with reference to the various tools, we have number of tools there. They include the preparation of the comparative statements, preparation of the common size statements, then with the help of the accounting ratios, with the help of the cash flow statement, with the help of the input-output analysis, with the help of the funds flow statements. There are number of tools, number of financial instruments through which we could have the analysis of financial statements. Today, we will discuss one very important tool for the analysis of financial statement that is known as the accounting ratios. So, as I told you, first of all, we must understand what we mean by the term accounting ratios. Basically, in a simple form, we could say it is an arithmetical relationship between two accounting variables. I repeat, it is an arithmetical relationship between two accounting variables. Now, if I say this particular line, we may not be able to understand what exactly the meaning of accounting ratio is. Now, I will share with you with the help of an example. If I say that A Limited has a gross profit of 1 lakh or B Limited has a gross profit of 2 lakh, A Limited has a gross profit of 1 lakh, B Limited has a gross profit of 2 lakh. Now only by giving this, we could simply say that B Limited gross profit is more than the A Limited, or B Limited gross profit is double than the A Limited, or B Limited is, you could say, the more efficient because it is earning more profit, because we have just studied the one single variable. But unless and until two variables are not studied in relation to each other, we could not conclude in a true way, in an authentic way. Now, with the same example, as just I had shared with you, that A Limited has a gross profit of 1 lakh, B Limited has a gross profit of 2 lakh. What was our conclusion? That B Limited is efficient, or the gross profit of B Limited is more. Now, if I say that the sales of A Limited is 5 lakh and the sales of B Limited is 20 lakh. Now, what will happen? We will again say that B Limited is more efficient because B Limited sale is 20 lakh and profit is 2 lakh. A Limited profit is 1 lakh and sale is 5 lakh. But again, we could not in position to get the true conclusion. How we will get the true conclusion? When we express at least two accounting variables or two variables in relation to each other. Now, if we prove or calculate the percentage of gross profit of A Limited, we would find there that the percentage of A Limited comes 20% and percentage of B Limited comes out to very simply only 10%. How we had calculated? Profit 1 lakh, sales 5 lakh. 1 lakh divided by 5 lakh, it amounts to 20%. For B Limited, profit is 2 lakh, sales is 20 lakh. Calculated it comes to 10% only. So we could see that the conclusion drawn only by one variable is not authentic. Unless and until two variables are not used and the relationship is not established, we could not get the true conclusion. So this way we could say very simply that the accounting ratio is an arithmetical relationship between two accounting variables, which gives us some very important true conclusions. Now, what ratio analysis is? Ratio analysis is basically a tool. Analysis, review. Ratio is a tool. Ratio analysis is what? Ratio analysis is a technique of analysis of financial statements to conduct a quantitative analysis of information in a company's financial statements. Very simply, ratio analysis is a tool with the help of which we can analyze the various variables of financial statements in order to arrive some authentic or quantitative conclusions in a financial statements of an organization. Now, in the financial statements of an organization, you know, number of type of information is given. Sales is given, purchase is given, expenses is given, incomes are there, losses is there, profits are there, assets are there, then liabilities are there. Again, in the liabilities, current liabilities, non-current assets, current, non-current, but number of type of the information is given. Now, ratio analysis helps us to understand the conclusions and to prove them through the various variables given under the financial statements. So, ratio analysis is a study of a relationship among various financial factors in a business so that some true or authentic conclusions can be drawn, and on the basis of that we could have the analysis or we could have the future projection of our financial outcomes. So this way we can understand what the accounting ratio is and what the ratio analysis is there. In our next video, I will continue that how the different type of the ratios to be expressed. Expression here means that how the answer of the different conclusions could be written. That is called as the expression of the different type of the ratios. So continue in our next video with ratio analysis and forms of expression.